Welcome back to Hurdle Rate. For this video, we're going to build a DCF from scratch for Deckers, the sports apparel company that owns brands such as Hoka, Teva, UGG boots as well. So let's have a quick look at the chart. As we can see, it's been on a bit of a wild ride over the last few years, similar to what we saw with Nike and Lululemon, where they had these huge during pandemic and post-pandemic rises. Then the last year they've sort of fallen off quite a bit. The reason I've chosen to do this one is because with Lululemon and Nike, we did see that it was quite undervalued. So let's see if Deckers could be the same as well. So first things first, open your Excel spreadsheet, go on to the SEC to pull up the financial statements, search for DEC, which is the ticker DECK. Select all annual, quarterly, and current reports. Select the most recent 10Q, the most recent 10K, and then the next most recent 10K as well, because it only reports in 2-year times, whereas normally we're doing them in 3s. So put in, first of all, always remove your grid lines. View, freeze your first column, insert another column before the A, and put DEC in cell A1. Go data, dot, hope it works today, it didn't the other one. That one. And it's this one, NYSE DEC. Okay, so the first, I'll zoom in a bit. We want ticker, date, the current price, implied. Then we want to know if there's any up or downside. Do a quick bit of formatting. In ticker, go equals A1 dot ticker. Price, A1 dot price. And the date today is the 5th of the 1st, 2026. And this first section is called assumptions. And we're going to break the company down by revenue segments so that we can simulate between different scenarios, the bear, base, and bull case scenarios. So there we have it. Okay, so come on to the financial statements now. Let's look at the 10Q. This one. No, not this one. Okay, here. So we're going to break this down into 3 revenue segments with the Hoka, the UGG, and other brands, and then we're going to break it down again into wholesale and direct to consumer. So it will be 6. We'll need 6 switches in total. So go Hoka, then wholesale, B2C, then we want UGG, then other, and so wholesale is when they'll sell to like a Foot Locker, direct to consumers, obviously, when they're doing it through their own channel, whether it's their own store or or their website. So usually the margins, obviously, the gross margin is significantly higher when you go D2C, but then you have to spend significantly more on marketing, so that can compress your operating margin. Whereas if you go with wholesaler, you get a lower gross margin, but you're spending less on you can be spending less on marketing. So it has both have their upsides and downsides. Then we want EBIT, WACC, and then the terminal growth value. Okay, the first section, actually, put a 2 in each of the switches, except the last two, and I'll explain why later. The WACC, the weighted average cost of capital, and the terminal growth value, we'll go through that when we get to it, but for now, we don't have to worry. We just focus on the revenue. Okay, so we start equals B10. We want wholesale. No, we're starting 2023. So Hoka's year finishes, I think, in the middle of the year. So they've already done the year 2025. So we'll be forecasting, we're halfway through their 2026, basically. So we're forecasting until 2031. Change it to a number, remove the decimal places, use the thousand separator and the brackets for negative numbers. So come on to the 2024 10K, which covered most of 23-24. We need to find so before they used to split down into Teva, but that's just gone into other, and Sanuk brand I don't think is with them anymore. So we'll put all of these into other. But let's start with a Hoka for wholesale. And this is in thousands, not millions. So we need to, so we need to put a decimal place here before the last bit, usually where the second comma is, because otherwise we want this to be in millions, not thousands. So 925.877, 1126.126. Look at the percentage of revenue. They come to 2020. I did a second ago. Let me find it. Yeah, this is what we want. I see on the last one they changed the order a bit. I guess they're going with whichever one is the largest. So 1397. 776. To work out the growth rate, you take the year divided by the previous year minus 1, and then just convert it to a percentage. Copy that along. Go. So 2026. We know that by the 6 months ended in September, we know they did this is confusing. 1 second. No, it's fine. So we just do 1398 divided by 695.06 to give us a multiplier. So we'd expect Hoka wholesale to do 843 multiplied by 0.97 multiplied by 2.01096.858. So we'd expect them to do nearly 1.7 billion in revenue for the full year of 2026. And that would be about a 20% growth rate from the previous year, but looks like quite a few percentage points less than what it was doing the previous year. So if we say for next year, the average revenue growth will be 22%. And we need to forecast what we think. So I think this growth probably doesn't last forever. So let's say it goes to 10%. 11. So to work out what the next, these three cells would be, we just go equals the previous year minus open brackets, the previous year minus the final year, close brackets, divided by open brackets, your final year minus your previous year, close brackets. We want to lock a few things in that we're going to use later. So this column always stays the same, but not the row. We put a $ in front of the K. This one always stays the same, so we lock in both. And for this one, the row stays the same, but not the column. So we just lock in the row. And there we have it. Maybe let's actually go a bit less. For the bear, I think there's a lot of, we've got tariffs. These are, we see things like companies like Nike, stage a comeback, etc. So I think there's probably a more, there's a greater, I guess, a greater downside on the bear than what we normally do of 95%. So we go the base multiplied by the bear case, lock the bear case in. That gives us what the scenario would be if the bear case plays out. We do the same for the bull. And we've only put it maybe a bit higher than the normal what we'd say for the base, because I think management expectations by say 2030 will be a much more mature growth rate of around 7%. So we'll go with that. Then to be able to flick through these different switches, we just go equals offset, select the cell that we're in, G33, the switch, lock the switch in, comma, 0. Pull this along. To work out the revenue projections, you just go the previous year multiplied by 1 plus your growth rate, close your brackets, pull this along, and there we have it. And to be able to see what we can do with the switches, remember these figures here. If we go on a bear case, see it comes down. This was 2074, it's now 2036. If we want to go back to base, then we want to go bull, see, it goes up. So that's what we do with the switches. Now copy this, and we want the Sorry, I'm getting my... So the D2C, come back onto the first 10K, the one with 23 and 24 on it. We want this figure here. So we can see the D2C is significantly smaller than the wholesale business. So the wholesale is very, very important to them, even though it's lower gross margin. $35.313. Then, so if we take that 835 divided by 420.998. So then we take 444.108 multiplied by 1.98, 412.819. There we have it. I doubt we'll see on a D2C this type of growth rate again. So let's make that a bit lower, and we eventually put it out to about 5% growth. And just make sure the switches are correct. So change everything in here where it says an 11 and this one to a 12, so that it's on the correct switch. So that's our forecast. That next year would be anticipating Hoka, both D2C and the wholesale, to be doing about just over 3 billion. Okay, next section will be the UGG, which was initially the largest revenue segment, but it looks like that's been overtaken by Hoka. So let's have a look. Back to 2023, we're looking at this here. UGG wholesale in 2023 was doing 1004.356, 1115.241. To 2025, 1282.319, and then for 1282 divided by 54.954. So 786.421 multiplied by 1.95787643. Oh, okay, well, it still looks a bit bigger, but we'll put this to, say, plateau out at 3%. G15. And I think we can go for 95% here and 105% here. Again, change it all to the correct switch. Equals E14. The direct to consumer is 924.855, 1123.891. What's the other one? One two four 9.032, and we do 1.249 divided by 525. Sorry, I got this wrong. Maybe because it's a winter thing. Direct to consumer. Would that be right? Divided by 257.862, 238.258 multiplied by 4.84, 380017. Keep it at 3%. I think because they're seasonal. That's why you're seeing this top heavy. I'll fix the zeros in a second. Okay, then we're going to go on to the other now. I guess that's 6 segments. It's quite a large revenue build. Okay, this is going to be quite difficult because we need to add for wholesale Eva, Anouk, and the other into one. So we'll be aware of that. So let's go. Equals 149.11 plus 27.678 plus 53.653. I think that is all of them. Equals 113.739 plus 17.175 plus 60.026. On to the other page. So on the other 10K, yeah, okay, we've got it right at 190. Rounded up. So that's fine. 175.770. And for the 10Q, we're going to say equals divided by 78.405, 2.24, which is going to be 59.075 multiplied by 2.2418222131. So this is a declining segment for them. So we should say Let's say it starts to decline at, let's say it goes to minus 5% from where it is now. So a better outcome would be, you have to, when it's negative, you have to flip these two around. Because if you do minus 5 times 0.95, it's a higher number than the other way around. Okay, come back to the 2023 one, and we're going to add this one, and this one. Three 3.950 plus 10.288 plus 10.479. Let's go to the 2024 and we can get the figure straight away rather than do the sum. $45.401. 2025, we did by 29.372 equal to 4.419 multiplied by 1.5472382. Again, we'll put it at minus 5. Okay, that's the revenue done. We can just put a border in. We just have to sum each of these segments. There we have it for the revenue. You know what? Let's make, because they are saying there will be tariff headwinds and other issues of competition from from everybody in the sports apparel space. So let's make this a bit more. 10% up here. The D2C, I think maybe, yeah, let's say it can grow a bit more. UGG put down to 10%. And I think that is probably a bit more. A bit more realistic, yeah. Okay, so the next thing we go on to, the next section, is the income statement. For this, we need revenue, which we just put equal to what we have up here. Then EBIT, which is the operating income. We want to know what that is as a percentage of the revenue. We find that on the income statement. So yeah, here it is. This one and this one. We're formatted properly. 652.751, then 927.514. $1179.092. Okay, so I mean, look, its EBIT margin is expanding, which is good. So here we just go equals 1179 divided by 437.893 equals 491.808 multiplied by 2.69264.866. Then we just take an average of the last few years, pull that along. This one is just a placeholder, so it won't actually have an impact on our DCF. So taxes, come back to the 2023 income tax expense, 149.260, 219.378. Divide your taxes by your EBIT to find out what your tax rate is. Tax expense, 277,208. For this one, we divided by 110. 0.119 equals 118.067 multiplied by 2.51734941. Then again, just take the average. Yeah. Then you take your EBIT multiplied by your tax rate, and then we have the taxes paid, or the taxes that will probably be paid by debtors going forward. The next section are the cash flow items. Your cash flow items are your depreciation and amortization, your capex, and your change in net working capital. And we find these on the cash flow statement, which is, on this one, it's going to be, here we go, on page F8 towards the end. Okay, so we start with this one, 47. 57.587. Then the capex is purchases of property, plant and equipment, 81.025. 89.365. Change in net working capital is we just sum all of these. A long one. Equals negative 0.806. Negative 26.056. Negative 5.609. 13.459. 8.308. So that's negative. Negative 13.240. Negative 74.247. .897. 17.6. Equals 4.157, 58.41, negative 38.490, negative 38.775, negative 0.567, negative 9.989, 1.601, 43.534, 35.016, negative 5.222. So all we're doing is we're just summing all of these to find out what the change in net working capital is. Come on to the other 10K that we have, the more recent one. And it is down here somewhere. There we are. This one. 69.353. 86.171. Then again, we just go equal sum, negative 41.39. So it looks here they probably had a bit of an inventory problem, but they've looks like they've resolved that. 20.946. 45, negative 2.583. 6.566. 5.636. 222. Negative 29.039. Negative 33.21. Okay, so for 2026, these will be at the top on the 10Q usually. It is. So if you take 69 divided by 33.750, we go equals 39.171 multiplied by 2.0549037. Do the same for the capex. $49.943 multiplied by 1.899423. And we just sum all of these. Negative 2231, negative 340.367, negative 70.1, 28.547, 5.133, negative 14.82177.05, negative 41.621, 42.685, 3.827. I mean, ideally, you want to be doing the change in net working capital, looking at what it's on the 10K, because it's very confusing when you're looking at it mid-year. But there we have it. Then take the revenue, multiply it by the percentage of revenue for depreciation and amortization. And then there we have it. We can also just have a see what D&A is as a percentage of capex. So it's significantly increasing. Okay. Now we're going on to the DCF. So we just repeat a couple of things first. Make sure everything is always linked, because then that way it can update dynamically. Now, let's do this one because it's positive. We will say the EBIT margin, if we forecast it to get to let's say 24%. Yeah, we'll go with that. So 20. Again, as always, so what this would be is instead you take your revenue multiplied by your EBIT margin. There we have it. So, are we forecasting too aggressively for 2026? No, I think we'll go with that. look at the taxes, percentage of EBIT. So taxes we put equal to here, put it along. You take your EBIT, multiply it by your tax rate, put that along. Now we can calculate our EBIT, the earnings before interest but after tax. And all that is you take your EBIT and you subtract your taxes. Then you pull in your cash flow items. Put another line here because now we calculate our unlevered free cash flow. And all that is you take your EBIT, you add back in depreciation and amortization, you subtract your capex, and then you subtract your change in net working capital. And there we have it for the unlevered free cash flow for the next 5 years. What we want to do now is we want to calculate the present value of unlevered free cash flow. And we need our weighted average cost of capital for that. So let's open up a new sheet. Do the usual, take off your grid lines, make your A smaller, your B bigger. We'll zoom in, put deck here, go data, docs. Select. Now, what is the weighted average cost of capital? It's your percentage of equity multiplied by your cost of equity plus your percentage of debt multiplied by your cost of debt multiplied by 1 minus your tax rate. So we begin with the market cap. And that is, we just go A1.market cap divided by 1 million though, so it formats correctly. So Deckers is about a $15.5 billion company. Then we want the percentage of equity, the cost of equity, and this consists of your risk-free rate, your beta, and your equity risk premium. After that, we have the debt, the percentage of debt, cost of debt, and tax rate. Put a total there, and then we go whack. So let's go through all of these. Percentage of equity, we can't do that yet because we need to add the market cap to the debt to get the total. So let's do that. Come on to the most recent 10Q. Let's look at the balance sheet. So we can see in the liabilities, so the company doesn't actually have any debt. So we just use the cost of equity. I'm reading that right? Yeah, there's no interest-bearing debt there, but if we were to go into the income statement, there is an interest expense. So where is the debt? Okay, well, if it's not on the balance sheet, we don't need to look at it. So yeah, this is a 100% equity company. So all we need to do is calculate the cost of equity, and that is your risk. I'll write it out. Cost of equity equals your risk-free rate plus your beta multiplied by your equity risk premium. So we know what the risk-free rate is. We just go onto the US 10-year, US 10-year Treasury, which is 4.181. The beta, so we would say that Deckers is apparel, and we'd also say shoe. I think we should actually, let's say it's a shoe company. It's Hoka, Uggs, yeah, we'll go with that. So 0.75 for the beta. For other companies, we can break it down by industry, but for this one, we don't really need to. It is a predominantly issue. Then for our equity risk premium, what we're going to look at is the ratio of what is domestic and what is international. So if we go region, we want the region revenues ERP weight, then weighted ERP. So we'll go 1340.788. $1054.590. And the ERP for the US, I can pull that spreadsheet up. Is 4.61%. Then for international, what we'll do is we'll just take away the North America. And we get this global 6.41%. And the weight, you just take, just sum these up. So your weight is your revenues divided by your total. Then you just go your ERP multiplied by your weight, and then sum the two up, and we get an ERP of 5.4%. Now, so the cost of equity is, no, sorry, we don't sum, we go risk-free rate plus your beta multiplied by your equity risk premium. Percentage, 2 decimal place. So that's what we're going to be using, this cost of equity here. Come back onto the other page. Percentage, places. This equals 8.23%. For a bearish case, we're going to add 0.5% on. For a bullish case, we're going to subtract 0.5%. And then we'll put the terminal growth value at 3%. Then instead of using the offset function here, we're going to go equals choose, whack, and make sure they're all in the order. That way they correspond with the correct switch. Copy this down, copy it there, and there we have it. So now up here, put 0.5 above 2027 and go equals +1 for 2028, drag that along, and you'll see why we're going to do this in a second. So we're going to discount these cash flows back to what they're worth today. So we go equals 1429 divided by 1 plus the whack, lock the whack in, close brackets up to the power of just pull that down. The next step is to calculate the terminal value. For this, we take the final year of unlevered free cash flow multiplied by 1 plus your terminal growth value, close brackets, divided by your WACC minus your terminal growth value, close brackets. That will show up in a second. Then we want the present value of the terminal value. Again, all this is 1 plus the WACC to the power from this. We can calculate the enterprise value, which is just the sum. Take your present value of your terminal value and your forecasted present value of free cash flow. That we have an enterprise value of 30 billion. To get the equity value, we add back in the cash and subtract the debt. So come back onto the balance sheet. And that's, where is it? 1.479. So they have about $1.4 billion in cash. We know there's no debt. So we go equals, you take your enterprise value, you add back in your cash, and you subtract your debt. Give you an equity value of 31 billion. From here, we just find out what the diluted shares outstanding are. They're usually on the income statement. We want this figure here, 1,486.638. 1,486.638. They have about 148 million shares outstanding, diluted, but it's not too different from the basic and the diluted. So, yeah. Then all you do is you take your implied share price and you divide it by the diluted shares outstanding, and we get a target price of an implied share price of $212. So let's plug this in. No, I've forgotten. K144. Oh, it's K143. We have it. So the up or downside is you take your implied divided by your current, right? 1. And yeah, so I mean, it could suggest that this company could double in price. On a bearish 170, on a bullish 270. So there could be upside in this company, just like we saw with Nike and Lululemon. But remember, play around with your forecasting of what you're putting as your base case and your bull case, and put your own figures in, do some more research, and see what comes out. But yeah, That's good. Remember, this is not financial advice, but please do hit subscribe and I will see you on the next video. Thanks again for watching. Thank you. Bye.